Audit finalization represents the concluding stage of the external audit engagement, during which the auditor evaluates whether sufficient appropriate audit evidence has been obtained to support the audit opinion. This phase integrates the results of planning, risk assessment, substantive testing, control evaluation, and completion procedures into a comprehensive assessment of the financial statements as a whole. ISA 700 forming an opinion and reporting on financial statements, together with ISA 450 evaluation of misstatements identified during the audit, requires auditors to consider whether the accumulated evidence supports the conclusion that the financial statements are free from material misstatement. The final review therefore serves as an essential quality control mechanism, ensuring that significant audit risks have been appropriately addressed, professional judgments are adequately supported, and the auditor's opinion is based upon a complete and objective evaluation of all relevant evidence. The overall review is fundamental because audit evidence is accumulated from numerous sources and procedures throughout the engagement. Although individual account balances may have been tested satisfactorily, the auditor must evaluate whether the financial statements, when viewed as a whole, present a true and fair view in accordance with the applicable financial reporting framework. The overall review provides an opportunity to identify inconsistencies, unusual relationships, omitted disclosures, or unresolved audit issues that may not have been apparent during earlier stages of the audit. It also enables the engagement partner to confirm that audit objectives have been achieved, material risks have been addressed appropriately, and the audit has been conducted in compliance with international standards on auditing and ethical requirements. Without a comprehensive final review, significant matters affecting the audit opinion could remain unidentified. An important objective of the final review is to determine whether sufficient appropriate audit evidence has been obtained. Sufficiency relates to the quantity of evidence collected, while appropriateness concerns its relevance and reliability in supporting audit conclusions. The auditor should assess whether evidence obtained from tests of controls, substantive procedures, analytical procedures, external confirmations, written representations, and subsequent events procedures collectively provides reasonable assurance that material misstatements have been identified or appropriately addressed. Where evidence remains incomplete, contradictory, or insufficient, additional audit procedures should be performed before the audit opinion is finalized. Professional skepticism and professional judgment remain essential throughout this evaluation, particularly in areas involving significant estimates, management bias, or fraud risk. The auditor performs a range of overall review procedures during audit completion. One of the most important procedures involves conducting a final analytical review of the financial statements, comparing current year results with prior periods, budgets, industry averages, and auditor expectations to identify unusual fluctuations or inconsistencies requiring explanation. Significant changes in profitability, liquidity, gearing, inventory turnover, receivable collection periods, or expense ratios may indicate previously unidentified misstatements or inadequate disclosures. The auditor also reviews whether accounting policies have been applied consistently and remain appropriate under the applicable financial reporting framework, ensuring comparability and compliance with accounting standards. The overall review also includes evaluating the presentation and disclosure of the financial statements. Auditors confirm that all required disclosures relating to accounting policies, related party transactions, contingent liabilities, subsequent events, going concern uncertainties, financial instruments, and other significant matters have been appropriately included and clearly presented. Cross-referencing between financial statement notes and primary statements should be verified to ensure consistency and completeness. Compliance with legal and regulatory disclosure requirements should also be confirmed, particularly for listed entities or organizations operating within highly regulated industries. Proper presentation enhances transparency and enables users to understand the entity's financial position and performance fully. Another important aspect of audit finalization involves reviewing subsequent events, going concern assessments, and written representations obtained from management. The auditor should ensure that all events occurring between the reporting date and the auditor's report date have been appropriately evaluated for adjustment or disclosure, that management's going concern assessment remains appropriate based on available evidence, and that written representations have been received covering all significant matters relevant to the audit. In addition, engagement working papers should undergo final review to confirm that significant judgments have been documented adequately, outstanding review points have been resolved, and audit documentation supports the conclusions reached by the engagement team. Throughout the audit, auditors accumulate identified misstatements, whether factual, judgmental, or projected from sampling results. Uncorrected misstatements are errors identified during the audit that management has chosen not to adjust in the financial statements. Individually, such misstatements may appear insignificant. However, ISA 450 requires auditors to consider their cumulative effect because multiple individually immaterial errors may collectively become material. The auditor maintains a summary schedule of all identified misstatements throughout the engagement and reassesses materiality during audit completion to determine whether the aggregate effect could influence the economic decisions of users. Consideration should also be given to qualitative factors, as relatively small misstatements may still be material if they affect regulatory compliance, management remuneration, debt covenants, or earnings trends. The effect of uncorrected misstatements must be evaluated carefully before the audit opinion is finalized. Where management refuses to correct identified errors, the auditor should assess whether the aggregate misstatements exceed overall materiality or distort the financial statements in a manner that affects their true and fair presentation. Even if quantitative materiality thresholds are not exceeded, qualitative considerations such as intentional bias, fraudulent reporting, or misleading presentation may justify requesting correction. The auditor should communicate all uncorrected misstatements to those charged with governance and obtain management's explanation for refusing adjustment. Such communication supports transparency and enables the audit committee or board of directors to fulfill their governance responsibilities regarding financial reporting integrity. If the cumulative effect of uncorrected misstatements is material but not pervasive, the auditor may issue a qualified opinion because the financial statements contain material misstatements. If the effect is both material and pervasive, an adverse opinion may be required because the financial statements fail to present a true and fair view. Conversely, where uncorrected misstatements remain below materiality and do not affect users' decisions, the auditor may issue an unmodified opinion while documenting the rationale supporting the conclusion. Appropriate evaluation of uncorrected misstatements therefore plays a critical role in determining the final audit opinion. Audit finalization and the overall review represent the culmination of the entire audit process, ensuring that all significant risks have been addressed, sufficient appropriate evidence has been obtained, disclosures are complete, and identified misstatements have been properly evaluated. Through comprehensive review procedures, analytical evaluation, communication with management and those charged with governance, and careful assessment of uncorrected misstatements, auditors provide an informed and independent opinion that enhances the credibility, transparency, and reliability of financial reporting.